According to Debtbusters, 95% of people who applied for debt counselling during the second quarter had personal loans. 54% of them are on one-month payday loans of more than 23% interest per annum. Interest rate cuts and two-pot systems have been used by some to consolidate loans as many battle to maintain household costs. Joining us to give us more insight is Debtbusters Executive Head Benay Sager. Benay, thank you so much for your time and for joining us this morning. What would you say are the key factors that are driving consumers' ongoing reliance on personal and payday loans despite the recent interest rate relief?
Yeah, I think the number one factor is the fact that take-home pay hasn't really improved over the last several years. And I think we have to just be clear about what we mean by that. Gross salaries may increase over time, but the combined impact of inflation as well as tax bracket creep, as well as things that are regulated in terms of pricing, such as electricity and rates and other things, has really made a big dent in consumers' take-home pay and what remains after debt repayments. So as a result, the cost of doing business has really gone up, and particularly for things that we're spending. For example, things like medical aid and others have grown at double digits, 10%, 12%. Part of the reason for that is all linked to an economy that is not growing. We're not getting enough young people into the workforce. As a result, those of us who are supporting the medical aids and things, the number is shrinking. I think all of this is really putting the pressure on income earners in the households to really need to borrow money to make ends meet. I think that's the number one reason why we're seeing the pressure on the consumers.
And I mean, since 2016, electricity tariffs have doubled. The price of petrol has increased by 75%. Those are really alarming numbers. So how does Debtbusters just interpret the data that's showing that 95% of those seeking debt counselling have personal loans? Or what does this indicate about the broader debt landscape?
I think it's pretty clear. With this debt index, we see something that also mirrors with another research that we had done a few months ago called the Money Stress Tracker, which was where we asked people how they're feeling about the pressures of finances. The two of them mirror each other. 70% or more of the population is really under financial strain. And I think the way to interpret the fact that almost every applicant had a personal loan is exactly what we were talking about a few minutes ago, in the sense that the lack of income growth has really pushed people in a need to plug the gap between what they're earning and what they have to spend. And as a result, personal loans and use of credit card facilities especially has become a lifeline for many. I think those are the realities we're facing. Several years ago, if we had this conversation, we would have said maybe there's a bit of luxury spending, this and that. But really, we're seeing that the money is actually spent on necessities of life, not on luxuries.
How effective do you believe the current interest rate relief measures are in alleviating those debt burdens, and where are the gaps that still exist for consumers that leave consumers vulnerable?
I think it is having a positive impact. So we had, 100 basis point reduction in interest rates. It will have an impact, and certainly has. I think what also has had positive impact is, despite the fact that petrol prices are higher compared to 2016, it is not as high as it was about a year and a half ago. I think those two things have certainly helped. What also has helped is some people accessing retirement funds. Although we have to caution that you have to make sure you're weighing out the positives of short-term relief with negatives of long-term deprivation of funds if you are planning to retire. I think the reality is that inflation is also more under control. All of these things are positive, but in the end, I think the cost increases have been so overwhelming for our consumers that it's really just not enough. I think what we deeply need is a broader increase in the taxpayer base, more young people going into the workforce for meaningful jobs, and making sure that they are properly employed, earning the right salary and feeling good about themselves. I think a lot of what drives this is the confidence. And right now, we probably don't have as high of a confidence as we did perhaps a year and a half ago about what the future holds.
So, Benay, if I'm an ordinary South African finding myself in a large amount of debt, what would you say are the first steps in ensuring that I just step out of this dark hole that many South Africans find themselves in?
Yeah, I think, Katleho, we try to simplify things from a consumer perspective, and I always talk about three things. If you are short on income, and you want to boost your income, look for opportunities where you may be able to increase your income through various means. Ideally, not via loans, because that's a temporary measure. If the second thing is, if you're short, or if you are really feeling the pinch of expense increases, see where you can potentially cut back on expenses. Maybe you can replace things that you're buying with cheaper alternatives, or buy less of something, or pool your resources with other, or forego buying things, if it's about that. If you're, and the third thing is, if you're really struggling with debt repayments, particularly if you're spending more than 30% of your take-home pay on debt repayments, you have to talk to a debt counselor to see if this debt repayment can be restructured. I think the good news is we have a fantastic system where it can be restructured, but many consumers are not aware of it. And I think we really urge our consumers to explore, for all three areas, possibilities.
And I guess if consumers are drowning in debt, then the issue of saving is one that doesn't quite exist within their budgeting means.
It's very difficult. I think, if you look at some of the numbers we also publish with regards to how much is left for savings and even for retirement, it's very little. It's less than 1%. This is particularly bad for lower income groups. There's just nothing left. I think our reality is, we, of course, want to cover what's immediate, what's urgent for ourselves right now, which is short term. And I think the thought doesn't even enter the consumers' minds, those consumers we speak to. It doesn't even factor into anyone's life in terms of putting away. However, having said that, I think it's a brilliant idea. If you can put away even 50 Rand or 100 Rand a month to build up an emergency fund that will be, in line with what you deem to be an emergency. It doesn't have to be a lot, but normally, let's say 1 month's take-home pay, more or less, if you can even put aside something like 5 to 10,000 Rand over time. We understand this will take a few years. It can only help you in the long term. If there's something unexpected that happens, you can tap into that money.
And the trends that you've observed in consumer behavior regarding debt accumulation and just the repayment during such a period, how do these inform your intervention strategies?
I think normally we would have expected consumers to pay, when it comes to debt repayments, we would have expected them to pay their mortgages first and vehicles second and other things first. What we're finding increasingly is the first thing that consumers make sure is up to date is the credit lines and credit facilities. And this, the home payments become second priority and vehicles a third priority. And the reason for this is, we need that credit line. And what that means is that's generally coming with really expensive lending, normally around, we say, 23, 25%. That's very significant. We need to make sure we're using our credit lines for the right purpose and not really for paying things that we shouldn't or couldn't afford. So I think it's very important when we give people advice about what is the credit line being used. In the end, we all need credit to actually survive. I think credit is not necessarily a bad thing at all. In fact, we wouldn't be homeowners, or we wouldn't be able to afford cars or anything like that if we didn't have access to credit. But to use it responsibly, I think the advice we would give to people is, particularly for if you're using credit cards and so on, make sure you understand what your minimum repayment amount is, and make sure that you can cover a lot more than that. Otherwise, you're going to keep paying interest. For vehicles, we tell people to factor in the balloon payments. This has become larger over time. It's become a lot more significant. And I think we're certainly seeing that, especially with younger people. Understand, particularly for vehicles, what you're signing up to. What are you going to need to pay at the end of 4 or 5 years or 6 years? Or we're even seeing some loan repayment terms of 8 years. Make sure you understand the economics of what's going to happen. And shop around. I think these days there are fantastic platforms where you can get comparative loan deals. Don't just get into and sign the dotted line with the first one that you see, but ask the right questions, understand interest rate and things like that.
Because it will bite you in the long term. Benay Sager, thank you so much for your time and just giving us these insights for the second quarter of 2025 and how the debt index shows that 95% of people applying for debt counselling have personal loans.